Today's news circulated this piece that raised investors' eyebrows, and it was from the information who raised fresh doubts about one of the market's most important, powerful engines out there, which is artificial intelligence. And what this report went in to talk about was Oracle's internal documents and how they showed relatively small profits from its cloud division that provides specialized servers to OpenAI and others. And that headline sent ripples throughout the entire tech sector. We've seen the S&P 500 fall after reaching its 32nd record high of the year just yesterday. Well, today it was down 0.4%. The Nasdaq, it slipped down 0.7%, retreating from its own record. The Dow, that finished lower by 0.2%. Now, the pullback wasn't dramatic, but the questions it raised, that was kind of dramatic, because behind the rally sits this complex, almost circular flow of money connecting from NVIDIA to OpenAI to Oracle to AMD to CoreWeave. All of these companies are kind of intermingled. So here's how it works. NVIDIA invests $100 billion into OpenAI. And then OpenAI turns around and uses that money to buy NVIDIA GPUs. And then OpenAI also signs this deal, $300 billion deal with Oracle, who in turn buys $100 billion worth of GPUs from NVIDIA. All right, y'all get where we're going here. And then OpenAI itself invested into AMD, potentially owning up to 10% of the company. So pretty much, in other words, NVIDIA invests into OpenAI. OpenAI buys or invests into some of NVIDIA, or what NVIDIA sells, kind of propping up their sales and revenues that they bring in. Oracle builds around NVIDIA, and then AMD profits off of the entirely same cycle. And it's pretty brilliant. It's efficient, but it's also circular. It's kind of like a pyramid scheme in a way. And this loop is what's keeping the AI infrastructure humming and these profits rising. But what it's doing is raising a ton of concerns, because everybody's feeling kind of uncomfortable right now, and they're questioning how sustainable is a system where each company's growth depends on another company's purchases, often financed by the same money going into the circles. But I mean, even Goldman Sachs called out the circular nature of these deals this week. Their estimate is that these partnerships will account for less than 15% of NVIDIA's expected revenue by 2027. And that sounds reassuring depending on what point of view you're looking at it from. But if those 15% ever evaporated, the ripple effects could reach every major tech index. But who knows? Maybe it's not a bubble. Some on Wall Street are calling it a modern day bubble. Market strategist Tom Essay warned that AI valuations, they're pretty good, and cross-financing are starting to look a little eerie, though, if similar to the dot-com era, if you will. But, I mean, it just kind of depends, like I said, on what point of view you're looking at. So he says that if the bubble bursts, the S&P could fall this 10 to 20%, driven by earnings downgrades for companies like NVIDIA, like Meta, like Microsoft, and even a pullback in industrials and utilities as AI-driven begins to kind of slow out. But for now, though, the optimism keeps winning, because just last week, we just talked about it. We talked about it in another video, too. AMD has had its best day in a year on the news of another big OpenAI deal where, like I said, OpenAI will potentially get a stake of up to 10% of AMD's ownership. So investors are chasing the story, not necessarily the numbers, and that's always when the risk hides the best. But, I mean, away from AI, Jamie Dimon, he's feeling pretty good, at least as far as the government shutdown goes. So JP Morgan Chase CEO Jamie Dimon said that the ongoing government shutdown is the wrong way to run the country, but he doesn't think it poses a lasting risk on markets. And then just kind of going into it, a lot of people's reminding that October has a way of surprising people, and they look back at 1987. The S&P 500 had its largest drop. It fell over 20%. And that wasn't really a good time. It fell over 20% in a single day. And then in 2008, it dropped 17% in a single month. And today, traders are starting to hedge themselves again, but there are a few different scenarios where it could play out pretty good. But the VIX, which is the Wall Street's fear gauge, has risen for 5 straight sessions alongside the S&P 500, which is something that hasn't happened since 1996. And that's this subtle signal that traders are preparing for some type of turbulence as we're entering into October. It's known for its higher volatility, and looking back in history, that's exactly what it shows. But stocks keep going to record highs. But I mean, just scrolling through here, maybe AI is not this bubble. Maybe credit stress hits the economy, maybe it doesn't. Consumers may be still able to spend through it. Maybe the labor market survives despite all these people being laid off and AI taking our jobs, and we're completely doomed, but the stock market is still heading higher. And then meanwhile, beneath the surface, the consumer story is softening quite a bit. CarMax reported that rising loan delinquencies are now this concern, and credit card balances are beginning to rise or fall. They have fallen 2.5% over the last year, which was the biggest drop since the pandemic. And that's not just because people are suddenly saving money. It's because they're running out of room to spend. So consumers are cutting back. Inflation is still sticky. Wage growth is slowed. And the job market's cooling. The Fed's latest data shows that households are more cautious than ever than any point since 2010 outside of the pandemic. And that doesn't scream some type of crisis yet, but it does whisper late cycle. And then at the same time, Americans are getting more pessimistic. So a new report from the New York Fed backs that up. Consumers now see this 41% chance that the unemployment rate will rise over the next year, up 2 points from August. Expected earnings growth fell to just 2.4%, which is the lowest since 2021. And 1 year inflation expectations ticked up to 3.4%. And people making under 50,000 reported the biggest jump in expected inflation. It's really tough out here. Exactly the group most affected by tariffs and the rising living costs. I mean, that's hitting everybody, but this demographic 50K to under, the median earners, they're really feeling the bite right now. And then interestingly, spending hasn't collapsed yet. We still got these high income households. They're still driving consumption thanks to home equity and stock market gains. That wealth effect is helping the rich people who are getting more rich continue spending. But what about this lower demographic of people who make up the majority of the population, how they're all struggling right now? So I don't know. Is that like a red light yet? Is that a red flag? But, I mean, that's what's helping the economy afloat for now, the rich people. Shout out the rich people. But as credit tightens and hiring slows, that strength could fade fast, very fast. Fed Governor Stephen Myron came out and spoke today. And really what he spoke about was his message being cautiously optimistic. Nothing he's really changed yet. He believes most of the uncertainty that clouded the economy earlier this year has passed by, mainly referring to tariffs, but warned that monetary policy has quietly become too restrictive. So he's really kind of taking an aim at the other Fed members for where they're holding rates. He says the neutral rate, that the rate that neither boosts or breaks growth in the economy, that has come down. And if that's true, then today's rates are tighter than they appear, and they need to go down from Stephen Myron's point of view. And that's exactly why he dissented at the last Fed meeting, voting for half of a point cut rather than that quarter cut that we got. He also said he's less worried about inflation than some of his other colleagues, expecting housing disinflation to help bring prices back towards their target. But he also acknowledged it's hard to confirm with real data because this shutdown, they're pretty much in the blind, and it's this government shutdown has halted the release of government inflation reports and a lot that they rely on. I'd imagine they still got their own way of seeing snippets at the very least. But until Washington reopens, the Fed is essentially navigating the economy with one eye closed, if not both eyes closed. They're like, yeah, I don't want to cut rates. It's kind of been like that the whole time. But where we are right now is markets slipped today on doubts about AI profits, about it being this potential Ponzi scheme. Analysts are questioning the sustainability of this circular investment between these tech giants who are kind of just feeding each other on borrowed money and like turning around and invest the money back into the company. It's really messy, and consumers are showing cracks. Credit use is declining, and inflation expectations are creeping higher while the Fed is flying blind without their official data. Still, the broader economy hasn't hit the wall yet. There's resilience out there, and especially among the higher income households, those rich people. Shout out the rich people, like I said, and corporate earnings momentum, which is keeping up. But when optimism, leverage, and valuations all start climbing together, history reminds us that all good things must come to an end. They never last forever. So that's where we're at today, everybody. Hope your day was awesome. Have a good one. I'll just see you tomorrow.